for national income determination, meaning where is nominal GDP going? That's the model. And that is a reliable model. Now, that worked in the past. And as I say, if you look, just looked at 147 countries over a long period of time from 1990 to 2021, and it worked there. So it works. But most central bankers aren't looking at that, with the exception, I gave you the United States, big country, European Union, ECB, big,
yeah.
UK, important. But some countries, particularly those in Southeast Asia, actually do pay attention to the money supply. If you look at India, it's behaved pretty well. You look at Indonesia, they're hitting what I call Hanke's golden growth rate. They're growing the money supply at a rate that's consistent with hitting whatever their inflation target is. China has been pretty good. So China, huge economy, of course, and it's doing pretty well and paying attention to the money supply. So that's kind of the background. Now, the important thing, you mentioned interest rates, and to paraphrase Milton Friedman, who was a big champion of the quantity theory of money, Nobel laureate in economics, of course, and one of my mentors, Friedman said, monetary policy is not about interest rates, it's about the changes in the money supply. So you got to look at the money supply. Now, if we look at the money supply and what's happened, you indicated that it had soared up in 2021. It went up over, it was almost 27%, which, by the way, the golden growth rate in the United States for the growth in the money supply measured by M2, it's consistent with hitting an inflation target of 2%, which is the Fed's inflation target. It's about 6%. So it soared up way above the golden
4 times more than what it should have been.
Absolutely. And now, where is it? It's come down, and it's been contracting for over a year. Since March, actually, of 2022, the money supply is contracted by 4.5%. Now that's almost unprecedented. There have been 4 periods in United States history where we've had money supply contractions, where it's actually been negative over a considerable period of time. One was in 1948-49, another was 37-38, and then, of course, the big one, 1933, and then before that, 1920-1921. All of those episodes were contracting money supply, and what happened? Well, one, we got the Great Depression. 1929, 1933, and the others we had big recessions. So that means what? That means that next year, 2024, we are going to witness a recession in the United States. And that is baked in the cake, because economic activity is generated with a lag of what changes are in the money supply. So you change the money supply a year and a half in advance.
Absolutely.
And then you see it coming. So I know it's coming, because we've never had these kinds of contractions, with the exception of these 4 periods I've given you. So we're almost 100% we're going to have a recession. Now, what about inflation? You said it was 3.1% now and falling. Greenwood and I think by the end of 2024, it'll be somewhere below 2%. It'll actually be below the target of 2%.
2%.
So that's the forecast, and the model is the quantity theory of money, and
that again isn't too conducive. Inflation falling below 2% is deterrent to a healthy economic activity. Correct me if I'm wrong.
Well, falling below 2% starts, number one, it's below the target. And why is it going to be below the target? It's because the money supply growth rate right now on a year-to-year basis, it's contracting, by the way, at 3.2%. And with that kind of contraction, that's way below the golden growth rate of 6%. That's an unhealthy rate of growth in the money supply. A healthy growth would be around 6%, 5 or 6%, like that. So what the Fed has given us here is kind of a roller coaster ride, up and then down, up and down, and now we're on the downside.
So actually, that was going to be my next question, follow-up question. I was just coming to the part that, we've seen these policies implemented at two big extremes. First, there was such an huge increase in money supply, and then there's been contraction beyond what is considered normal. Do you think that the Fed did they have a plan to do that, or do you think that they're just playing it by the ball? They haven't been able to really grasp the gravity of the problem and address it in a more logical, rational method?
Well, number one, they do not use the quantity theory of money. They have explicitly rejected it. So they pay no attention to the money supply. They're just focused on interest rates. And as I said, quoting Friedman, interest rates are not a good guide for monetary policy, only changes in the money supply. So they're just looking at the wrong thing. It would be like, let's say you were a pilot in an airplane, and there was nothing on the altimeter. The only thing that should be on the altimeter, if you're talking about monetary policy, is a money supply. But they're not looking at the money supply, so nothing is on the altimeter. Now that means you're flying blind. In short, to answer your question, they really don't know what they're doing.
They really don't know what they're doing. Actually, that's very.
They don't know what they're doing, and I think what we will see going forward is that they look very much at when they look at for real economic activity, they look at what's going on in the labor market. They tend to focus on what's going on in the labor market. In the labor market, the unemployment rate's still quite low in the United States, but it's deteriorating. And I think next year it will continue to deteriorate pretty rapidly as we go into recession. But remember, the labor market's always lagging. It lags behind. And think of it this way. Let's say you're running a business and sales starts going down. The first thing you do, you stop employing people overtime. You cut their overtime. And then maybe you would cut back their hours. But the last thing you want to do is actually fire someone, because you have a lot invested in human capital. A capitalist running a business, they like their labor. They've invested a lot in their labor. They've trained their labor. They don't want to fire them. So the last thing to go is labor. And that's why the labor market's a very lagging indicator. It's the last thing to go. But what will happen as we slow the economy down, the labor market continues to deteriorate, the Fed will see that, and eventually, but it'll be too late, they'll pivot and start loosening up.